Hello and welcome back to Easy Finance, the channel where we discuss complex financial topics in a simple way. Today's topic is one of the most important concepts in accounting and finance: liabilities. If you ever looked at a company's balance sheet and wondered what exactly they owe and to whom, this video is for you. Let's start with the basics. Liabilities are what a company owes to others. These are legal or financial obligations that need to be settled in the future, typically in the form of money, goods, or services. Think of liabilities as the flip side of assets. While assets represent value a company owns, liabilities represents claims against that value. These claims come from suppliers, banks, investors, employees, or even the government. For example, if a company borrows money from a bank, that loan becomes a liability because the company now has the obligation to pay it back. Or if it buys materials from a supplier and hasn't paid yet, that's another liability called accounts payable. So you might be asking, why do liabilities matter so much? Great question. Liabilities give us a clear picture of how a business is financed. Is it growing with its own money or heavily borrowing from others? They also show how much risk the company is exposed to. A company with too many liabilities and not enough income might struggle to stay afloat. Investors, creditors, and analysts closely watch liabilities to assess how stable and trustworthy a company is. For example, a company with low liabilities and strong assets is generally in a healthier position than one overloaded with debt. This brings us to the key accounting equation you will hear over and over again in finance: assets equal liabilities plus equity. This formula is the foundation of the balance sheet. Everything a company owns, its assets, must be financed either by borrowing money, so the liabilities, or by using the owner's or shareholders' capital, so the equity. If you arrange the equation, you can also think of it like this: equity equals assets minus liabilities. In other words, the more liabilities a company has, the less value remains for the owners. That's why understanding liabilities is crucial for assessing a company's net worth. Now, let's look at the two main categories of liabilities. At the one side, we have current liabilities, and on the other side, non current liabilities. The difference between them is pretty simple because the difference is all about timing, when the debt is due. Understanding this split is super helpful because it tells you which debts need to be paid soon and which ones are longer term and easier to manage over time. First let's look at current liabilities. These are obligations that must be paid within 1 year or within the company's operating cycle, whichever is longer. These are often used to cover daily operations. Common examples include accounts payable, the money owed to suppliers, or the short-term loans. This is like a business credit line. Also, wages payable are current liabilities. For example, wages payable are the salaries the company still needs to pay to the employees. Or the taxes payable. Taxes payable are unpaid income or sales tax. High current liabilities might signal liquidity problems. If the company doesn't have enough cash or assets it can quickly turn into cash, it can become a problem. That's why analysts often compare current liabilities to current assets in what's called the current ratio. So you can directly see if the company has enough current assets for the current liabilities they owe. On the other side, we have non current liabilities, also known as long term liabilities. These are obligations due after more than 1 year. These are often related to long term investments or financing strategies. Examples include long term loans from banks, corporate bonds issued to investors, leases that extend over multiple years, also something like pension obligations or retirement benefits. Companies usually use non current liabilities to finance large assets like factories, equipment, or major expansion projects. These liabilities aren't necessarily bad. In fact, when used wisely, long term debt can help companies grow faster. Let's bring all this together with a simple example. Imagine company X. They have total liabilities of 500k. Of that 500k, 200k are current liabilities. So you have to pay these liabilities within 1 year. And 300k are non-current liabilities. So these are liabilities you have to pay back in the next years. This tells us something right away. The company's short-term obligations make up 40% of its total debt. The rest, the 60%, is more manageable over the long term. By comparing these numbers to the company's assets and cash flows, you can get a clear sense of how risky or stable the company is. Also, you can't standardize it for every company because also it depends on the industry they're working in. But if you compare, for example, the current assets and the cash flows with the current liabilities, for example, you can see if the company is financially healthy. A quick warning here. Many beginners confuse liabilities with expenses, but they're not the same thing. Liabilities are what you owe, like a loan you haven't paid yet. Expenses are what you have already spent, like rent, utilities, or wages for the months. Expenses go on the income statement, so on a different financial statement. Liabilities appear on the balance sheet. Both are important, but they serve very different purposes in financial reporting. So, why do investors and financial professionals care so much about liabilities? Because liabilities tell the story of a company's risk profile. Is the company over-leveraged? Meaning, do they borrow too much money from others? Can they meet short-term obligations without running into cash problems? Or are they using debt wisely to fuel growth or just trying to survive? A company that manages liabilities well can grow faster, invest smarter, and attract more investors' confidence. But one that's drowning in debt can collapse, even if it has strong revenues. So let's quickly recap what we've covered. Liabilities are what a company owes, its legal and financial obligations. They are split into current and non current depending on when they're due. They are a key part of the balance sheet equation. Assets equals liabilities plus equity. Always remember this formula. And understanding liabilities helps you assess a company's financial risk, structure, and stability. With this knowledge, you will be much better prepared to reach financial statements and make smarter decisions. If you found this video helpful, give it a thumbs up and subscribe to Easy Finance for more clear and practical explanations of key financial concepts. You want to learn more about assets, equity, or valuation models? Check out the links in the description and drop your question in the comments. Thank you for watching and see you in the next video. Bye bye.